We often picture the global economy as a digital web of data, code, and silicon. But beneath every illuminated server farm and logistics network lies an older, entirely physical foundation. The next major economic transition isn't going to be driven exclusively by artificial intelligence or blockchain. It is being driven by a massive, unavoidable pivot back to natural resources. Currently, more than half of the world's total gross domestic product is moderately or highly dependent on nature. We are framing ecosystems strictly as invisible industrial infrastructure: the fresh water required for manufacturing plants, the healthy soils that guarantee yields, and the climate regulation that protects supply chains. Because nature functions as a core economic engine, degrading it is not a matter of corporate social responsibility. It is a direct, systemic risk to the global supply chain. Look at where global capital is flowing today. In 2023, roughly $7.3 trillion was invested into activities that actively deplete natural infrastructure. By contrast, a mere $220 billion was directed toward nature-based solutions. When we isolate the private sector, the disparity is even sharper. Private capital accounted for $4.9 trillion of that nature-negative finance, while contributing just $23 billion to positive solutions. The public sector is left covering 90% of the bill. That imbalance means markets are actively pricing in short-term extraction while completely ignoring the long-term degradation of the physical assets those markets depend on. It leaves massive vulnerabilities exposed across corporate portfolios. A $7.3 trillion capital misallocation of this scale represents one of the most severe market failures of the 21st century. The market is beginning to correct this failure by transitioning toward a nature-positive economy. Fixing this misallocation represents $10.1 trillion in annual commercial opportunities by the year 2030. There is a persistent myth that financing nature is limited to writing checks for charity, funding isolated conservation projects, or accepting low-yield impact investments. The data proves otherwise. The broader green economy accounted for nearly $8 trillion in listed equity market value in 2024 and has outperformed global equities by roughly 59% since 2008. Nature-positive business models have officially moved out of the philanthropy department and matured into highly competitive asset classes that demand serious institutional attention. This chart outlines a verified pipeline identified by the World Economic Forum. It maps out more than 50 investable, nature-positive opportunities across 13 critical sectors, ranked by their billions in annual business value. In agriculture and food production, we are seeing rapid scaling of smart irrigation sensors that optimize water use, precision fermentation for alternative proteins, and commercial seaweed cultivation. This case study highlights industrial circularity. Looking at the financial impact rows, we see how sustainable cement blends substitute virgin inputs with construction waste to directly reduce operating expenses. The same principles are being applied to bio-based textile recycling. In the mining sector, companies are replacing invasive, fuel-heavy helicopter surveys with AI-driven drone mapping, significantly reducing land disruption and exploration costs. These activities deliver financial returns in three distinct ways. First, through immediate operational cost savings by maximizing resource efficiency. Second, by reducing upfront capital expenditures, often by extending the lifespan of existing physical assets or repurposing waste materials. And third, by generating entirely new revenue streams while hedging corporate balance sheets against the volatility of raw material prices. These gifty opportunities are not theoretical concepts trapped in an R&D lab. They are deployable, commercially viable technologies, actively re-engineering industrial value chains today. The practical question is how financial markets actually evaluate and deploy capital across such a wide, fragmented variety of technologies. This diagram plots opportunities into four archetypes by technological maturity and capital intensity. Operational uplifts are mature, low-capital improvements suited for standard loans. Scalable opportunities require demand certainty, ideal for blended finance. Emerging innovations carry lower maturity but massive upside, prime for venture capital. This matrix strips away the ambiguity. It provides a clear, structured pipeline, allowing every class of capital provider to identify exactly where and how to enter the nature economy. To actually capture this value, financial institutions have to make an internal operational shift. They need to build what is called institutional nature fluency. Nature fluency means moving beyond a siloed sustainability desk. It requires banks, asset managers, and insurers to treat nature-related risks and opportunities with the exact same rigor, data, and analytical models they already apply to climate or credit risk. It means taking the public and supply chain data that already exists, like asset locations and resource dependencies, and hardwiring it into everyday underwriting tools, portfolio management, and investment screening. Shifting capital toward nature-positive solutions generates market-competitive returns while building physical business resilience against supply chain shocks, chronic weather events, and resource scarcity. With 50 mature technologies and the necessary financial instruments identified, the transition to a nature-positive economy is moving into the execution phase. The only question is, which investors are positioned to capture those returns?